Hi, everybody. Welcome to our DAT IQ Weekly Market Update. This is our update for March 30, 2021. I'm Dean Croak, Market Analyst here at DAT. I'm sitting in for Ken Adamo, and as always, I'm joined by Ned Damon, who's our Principal Data Scientist. And our guest this week will be Eric Williams, who's going to talk us through what shippers have been seeing in the last few months. Hey, Ned, how's it going?
You know, spring is coming. It's nice outside. Well, Portland nice outside, but relatively nice outside. So I'll take it. Yourself?
Yeah. I'm just happy the Suez Canal has opened up. I think everybody's breathing a collective sigh of relief. Things are bad enough as it is without.
Oh man, that guy, the captain. Do you think that they're all gonna razz him when he gets off the boat? Or
oh yeah. Well, I think the pilot might be the one, because every one of those ships has a pilot that goes through them. But ultimately, the captain is in control of the vessel. But that was a series of events that's sort of unprecedented. That was one of those really rare events that was quite unfortunate. All right, so let's dive into the show. For those new to the program, we're here every Tuesday, 10 a.m. Eastern, 7 a.m. Pacific. We're talking about trends in the freight market, but most importantly, we're here to answer your questions, so drop them in the chat section below, and we'll get to them towards the end of the program. But just a reminder, these pile up towards the end, so get your questions in early. We've got a crew working in the background to get them over to us as quickly as possible, and that way there's a better chance they'll get answered on air. In the event we don't get to you, there's a written version of the show at dat.com market update. Also in the show today, we're going to have a little promo of our Freight Focus show, where Chief Analytics Officer Ken Adamo interviews Jason Frederick and David Cochran from Miller Transfer. They're based in Ohio. They're specialists in flatbed, heavy haul, and over-dimensional freight. It's a great show. It's a pretty serious sector of the industry, and as someone who's run an over-dimensional freight where one of my drivers put a 4.9 metre high combine under a 4.4 metre bridge and turned a $500,000 machine into a convertible, I can attest to how important planning is in this sector of the industry. It'll be released at 7 a.m. Pacific, 10 a.m. Eastern on YouTube and podcasts. So that's it for the intro of the show. Let's dive straight into the freight market update. Some key trends we're watching this week. We're at end of month and end of quarter. That pushes more volume into the spot market as shippers clear their docks. Volumes were slightly higher last week, not as high as I thought. As a result, dry van and reefer spot rates ended March pretty much where they started, relatively flat over the course of the month. But flatbed, really, really different. Rates continue to increase. They've been increasing for the 8th straight week in a row. I think everybody collectively is happy the ship in the Suez Canal has moved on, but we've still got pretty big port delays. We're watching that very closely. The Port of Los Angeles Signal Report has the average wait time at 8 days, 7.9 days for ships at anchor. There's about 30 waiting at anchor right now. There's about 11 off Savannah. In terms of delays, about a third of Savannah's volume goes via the Suez Canal, and there are about 6 ships headed to Norfolk that were caught up in it as well. So there'll be some delays a little bit later on. We'll watch that in coming weeks. And of course, we'll talk a little bit more at the end of the show about produce season. We're at the starting gun. Growers are expecting a bumper season this year, especially as we start to work our way out of the COVID pandemic. All right, so let's start with load board activity in the dry van space. Volumes increased 3% last week. End of quarter, end of month really drove some of that volume. Truck post decreased slightly, so the load to truck ratio moved up as a result to 5.02, not a big movement. Similar story in refrigerated. There was almost no change for the 3rd week in a row. Truck posts increased slightly, so there wasn't a lot of change in capacity. So the load to truck ratio stayed about 11.07 to 11.02 for the last 3 weeks. Very little change at all. In the flatbed space, though, it recorded the largest increase. Load post volumes were up 4% last week. Capacity is extremely tight in the flatbed sector. The load to truck ratio moved higher again, up to 88.63, and it's getting really, really close to 2018 levels, which was, of course, was a very different economy.
I was going to ask about that. I mean, what do you think are the odds that it's just going to replay 2018, basically?
Yeah, Ned, I've been trying to figure this one out, and I'd love someone to offer some answers. But 18 was an industrial-led economy. We had oil prices, drilling, we had changes in the depreciation, in the tax acts. So there was all sorts of stimulus going on in the industrial economy. And spot rates for flatbed were about, I think for about 7 months, they were higher than contract for the first part of that year. So it really was a flatbed-driven rate rally. But this this year we've got a consumer-driven economy. So they're two very different economies, but all of our metrics, whether it's load posts, truck posts, or load to truck ratio, they all are tracking very, very similar so far.
Yeah.
All right. So wrapping up sort of the market condition index, let's start with dry van. In the top 10 markets, they represent about a quarter of our load post volumes. They were up slightly last week. Memphis was number one market, but it's sort of the logistics hub of the country. So not surprisingly, volumes dropped after the big increase the week before. Capacity eased, rates were down 2 cents a mile. Houston and Dallas, surprising, volumes increased 9% and 16% week over week, respectively. Capacity tightened in those two markets. Spot rates were up 4 cents a mile. West Coast and Los Angeles and Ontario, they made it back into the top 10 in terms of load post volumes. There's record volumes of containers, as we've been talking about in recent weeks. According to the Los Angeles Port Signal report, volumes are up this week 159% year over year. But next week, they'll drop back down to only 94% year over year. So lots of volume still coming through. But after load post volumes dropped for most of March, they jumped 18% last week in Los Angeles and about 7% in Ontario. Capacity eased in Los Angeles. Rates dropped a cent a mile, not a big change, but in Ontario, capacity tightened. Rates are up 2 cents a mile, up to $2.90, and shy of the $3 a mile that we saw back in November. And refrigerated, most markets reported gains this week. Again, Los Angeles and Ontario volumes are up about 7%. Rates dropped though. Reefer capacity was eased slightly. Rates were down 7 cents a mile in Los Angeles and about a cent a mile in Ontario to 306. Volumes dropped in Atlanta, down 4% week over week. No change in capacity. Rates stayed at 271 a mile, excluding fuel. As we said in dry van Dallas, capacity was much tighter again. Last week, rates increased by 6 cents a mile to 244, excluding fuel for all outbound loads. And as we talked about last week, import volumes across the southern border through the McAllen market, volumes are up about 8% year over year. So there's more volume coming across that market. Rates are up 11 cents a mile last week to 259. Capacity eased in Chicago. Rates dropped 2 cents a mile, but they're still pretty high at 333 a mile, excluding fuel. And in flatbed, load post volumes were up slightly last week, but capacity eased a little bit, but not by much. Rates only decreased a cent a mile to an average of 291 for the top 10 markets. I've been following the Mid-South region the last week. A lot of flatbed activity around Little Rock, Memphis, Decatur, Montgomery, Birmingham, Jackson. They're all sort of within this 1,000-mile radius, and about 17% of our load posts came from there last week. But volumes did drop 25% on average, and rates dropped about 8 cents a mile in that market. So it's one that we're watching very closely. Capacity was particularly tight in the Pacific Northwest in Medford. Volumes are up 13%. About 8% of those loads were headed to the Spokane market. Capacity was pretty tight. Rates were up to 304. So wrapping up with our year-over-year look at spot rates, as you can see from the chart, we're still up at record levels, up as high as what I've seen in 10 years data that I've got at my disposal. Rates moved up about 4 cents a mile last week, up to 236, excluding fuel. They remain up 66 cents a mile compared to the same week in 2020. Not a dissimilar story in refrigerated. Despite end of month and end of quarter, there was a slight increase in load post volumes last week, but capacity remains generally very tight. Rates increased only by a cent a mile to end at 263. And compared to 2020, rates were $2.02 a mile at the same time. So rates this week are higher by 61 cents. And wrapping up with our flatbed, year-over-year review, flatbed rates increased again. As I said earlier, 8 weeks in a row of gains. They increased by 3 cents a mile last week to 243. And they're now 48 cents a mile higher than in 2020 when rates were $1.95 a mile. And compared to the really tight flatbed market in 2018, rates are still 20 cents a mile higher. So that's it for this week's market update. If you want to find out more about what's happening in freight, go to dat.com/resources and download the market update. But before I hand over to Ned to go through the rate forecast, let's take a quick look at the Freight Focus show featuring Miller Transport, which is due out at 10 a.m. Eastern tomorrow on YouTube and podcast.
how often do you find yourselves educating the customers more than a typical, commodity hauler about what they're shipping and what they need?
From our past experience, as you can imagine, it is quite a bit different. So number one, the need for all that information up front. It's very important so we can develop the right solution and handle it right. If the weight's off, if the center of gravity isn't identified in the beginning, things can go bad pretty quickly.
Right.
So that's something completely different than the van world.
And if you're not experienced doing that, you don't want to find that out when you're going to get scaled.
That's right.
That you're all out of whack or something like that. It's important to understand when you're taking the shipment details down, what's going to be needed.
And those are all key for the simple fact of, if you've got a shipment that's, overly wide or overly tall, you have to run route surveys. I mean, you literally have to go and run the route that you're going to be on, that you're permitted for, to make sure, okay, there are overhead lines, are there light poles, are there stop lights, whatever it is. If you're going to make a turn, are there stop signs that could have to be removed, or are there tree limbs you got to cut down? All of those things have to come into play to make sure you're providing a great service to the customer.
Yes, looking forward to that tomorrow.
Yeah.
Okay, Ned, let's throw to you for the forecast.
Oh, absolutely. So we're going to begin with our dry van forecast. So you can see in the blue is the market rates observed by DAT. And then off to the right, you'll see our short-term forecast in red, our ratecast forecast in green, and two blended forecasts in gold and silver that are mixtures of the other two in different ways and in different amounts. You can see here that there's kind of broad model agreement through the end of April, with both the short-term and the ratecast model expecting things to trend down and to the right. But somewhat unusually, the ratecast model is a little bit more bullish heading into the end of April, with it expecting rates to kind of level out a little bit. I think it's going to be interesting to see what the impacts of things moving forward are, but definitely that is what I would expect overall. Moving forward to reefer, you can see that there's initial model agreement, but then divergence as we head forward. Ratecast in green is expecting things to trend downwards as we move into the middle part of April, and the short-term model, on the other hand, is expecting things to stay flat to up going forward. I think the impact of produce season is going to be one of the big questions about how these scenarios play out. And of course, the blended forecasts are ending up in the middle of the distribution. Finally, we have extreme model divergence in the flatbed space, with ratecast basically expecting a correction, a peak and then a correction coming very soon, with the short term expecting just continued up and to the right, and obviously the blended forecasts kind of straddling the internal part of that space. I think that flatbeds have been going up a lot recently, and that's been something that I've been kind of surprised by, but we'll see how things play out as we go forward. Are you handling the question of the week, Dean?
Yeah, yep. All right, so good. One of the great questions we've had is about produce season. That's why we've got Eric Williams on our show this week. So our Ask IQ question is, what's the expectation for rates during produce season? And to help answer the question, we've invited Eric onto the show. He's DAT's new Director of Shipper Operations. And for those that don't know Eric, we're very excited to have him at DAT. He spent 10 years as a floor broker and trader at the Chicago Mercantile Exchange, and quite a long period of time at XPO Logistics and US Foods in the food services industry. Eric's got extensive experience in brokerage pricing models, analytics, network optimization, capacity sourcing, and of course, all the all-important RFPs, which leads us to our question, Ask IQ question this week, which is about reefer rate expectations, plus the current capacity crunch and how shippers are dealing with it. So, Eric, first question, reefer carriers are expecting produce volumes to continue climbing based on a few factors. We're almost in spring. Produce growers are harvesting in the south. They've been harvesting in Florida for a while. There's a lot of pent-up consumer demand for eating out. That's likely going to increase food service spending. We're seeing a relaxation of social gatherings, increasing vaccination rates, all likely to accelerate those things. So what do you think that means for shippers and RFPs and spot rates in the reefer sector?
Thanks, Dean. So I think the first place to start whenever we're talking about produce, let's start with the premise that I think we can all agree upon. It's purely a supply and demand phenomenon. Happens every single year. So rather than kind of focus on the demand side of the equation, because I think those waters are still a bit murky, yes, I'm expecting a shift in consumer behavior. To what degree, I'm not as certain as others may be. But with that said, I think it makes sense to focus on the supply side or trucking capacity of the equation.
Mm-hmm.
But let me back up a bit and kind of discuss the framework that I would use when forecasting or planning a known increase in freight volumes. After all, this does happen every single year. So the first is try to forecast demand. Again, I think this gets a little tricky, and in my opinion, not especially necessary if you're trying to remain directionally correct. The second is to identify current consumer tastes, i.e. what's the flavor of the month, so to speak. This can help us guide us to understand which regions may be hotter than others and the harvest times associated there. But the third, and in my opinion, probably the most important, is where are we in the capacity cycle? So in a loose capacity cycle, volatility is not as high. When it's tight, volatility is high and gets higher. So with that said, I think we can jump into a discussion of the supply side. And I don't think anyone would argue the capacity is anything but tight right now. Is capacity entering the marketplace? It would appear that's the case, but delays in Class 8 orders turning into deliveries has certainly slowed that pace. Right. But what I want to talk about is some additional factors that are unique to produce season that could affect capacity. To your point, I think there will be a shift in consumer behavior. It would appear that most are predicting a large shift in consumption patterns and pent-up demand to get out and enjoy dining in restaurants. And I think that's great for the economy. I think it's great for where we're at as a country. So I think if you look at the current hiring trends in that industry, the data would tend to support this thesis, that there's an expectation that demand is going to be coming back online. So what does this have to do with trucking? Well, as we saw last spring, when trucking networks shift in response to different consumer behavior, asset utilization rates tend to go down and indirect costs tend to increase. I would expect the shift to restaurant consumption to play a role here, and I think that will increase market volatility. But what I think is most important to discuss is how much of current shipments are truly on tariff. And by that is how much routing guide leakage is there still in the marketplace. Typically, shippers are able to react to events like we saw in 2020, 2018, and they repair routing guides through their annual sourcing events and RFPs. What this does is it pulls some of those high-paying loads out of the marketplace. Carriers aren't seeing those anymore. They're not seeing the prints and the indices. So brokers don't have, they have to be a little more price disciplined. However, I would argue that the winter storms this year have rendered some of those efforts to be not as effective as planned. So my suspicion is the routing guides are not as intact as they could be, or shippers would want them to be heading into the produce season. So with that said, I think the answer is, and kind of some context around this, it takes some time to stand up a network, especially a large one. And the thing to keep in mind here is produce doesn't change or affect rates just for produce shipments. It affects all shipments, specifically those that originate in those geographies. So I would think it'd be very difficult for shippers to hold abbreviated sourcing events prior to the Memorial Day weekend to get in front of this. So if there is large routing guide leakage and capacity remains as tight as it is, I think you could probably see an expansion in volatility to the upside that's going to be similar to the fourth quarter of last year.
Yeah, it's interesting, Eric. We've seen. I was looking at some markets out of Raleigh, South Carolina, where you see a lot of peaches, even into Georgia, where you'll see a lot of Vidalia onions, which come online April 16. I mean, there's only 13 counties in Georgia, but it sort of sucks a lot of capacity into those markets. Ratecast has got rates up around $4 a mile, excluding the fuel, by mid-year. So it's certainly looking like capacity is going to be pretty tight all the way through produce season. Do you think shippers will change their, I guess my question is, do you think the length of haul will change now that food services has had to change so much of their distribution patterns?
I think it's a good question. My answer to that is I wouldn't think so, because you're still going to be utilizing the same vendors that you've always had. I don't think that they've necessarily moved or shifted their operations. Now, there's certainly been efforts to kind of trade down and have substitutes in inventory. If you can source it closer, you probably should. But that's very customer specific. If they want a specific product, then you service the customer. And if they want beef from a specific packer, that's where they're going to order their beef from, and that's unique to their brand. So I wouldn't anticipate that a whole lot. I do think that there will be an effort, specifically by food shippers, to increase truck sizes. I think you'll probably still continue to see more consolidation and multi-stop loads, just because that kind of helps them minimize some of the costs, even though it may increase their cost. But ultimately, for their net freight income, it tends to be a little more positive.
Okay. All right.
I have just one more quick question before we go to user questions, and that's, you mentioned that Class 8 truck orders, there's a lot of them coming online, but obviously there's another part to adding capacity, and that's adding drivers. My understanding is that it's been really difficult to add drivers recently. And if you could speak to that just briefly before we handle some user questions.
Yeah, without going into too much of my previous employer's network, everyone struggles with hiring drivers. And there's one of the things that food shippers are going to have to be aware of is a lot of food distributors have their own private fleets. As deliveries come back online and those become more prevalent, there could be a shift away from some of those private fleets hauling some of that inbound freight. So that's another thing too that probably is keeping food shippers up at night right now.
Excellent. I think we have some time for some quick user questions. Let's do some lightning round. Both Fluke196C and Chris have asked about the impact of the Suez Canal closure on just sort of domestic freight going forward into the near future, and also shipping revenue, if that's relevant.
I'll have a quick go at it. I've got a little bit of a write-up about it in this week's market update, but I think it could be mostly an East Coast phenomenon. There's already 11 vessels off Savannah, so there is some congestion. We'll probably see more congestion around those markets. Throughput, they'll have some throughput challenges getting containers onto the wharf. So there could be some more volume, but I think it'll be very cyclical as opposed to more even like it's been when throughput is more normal.
Fresh Air Brown asked, just jumping in, how is the rate in the Northeast for reefer? So I did some snooping in RateView, and right now, reefer in the Northeast, I'm speaking specifically about the DAT New England region, is running about 5 to 10 cents below what it is for other comparable regions, where I'm defining that as like Mid-Atlantic, Carolinas, up Great Lakes. Anything to add, Dean or Eric?
No, I'd have to dig deeper into the markets to get you some more color on that.
Yeah. Jack from Uber Freight asks, many expect nominal van rates to come down in about 2 to 3 weeks following Uri's thaw. Other than produce season kicking off, do you guys have any insight into what's keeping rates elevated?
Yeah, I think just quickly, Eric can maybe answer this also, but one of the things that happened last year was because dry van rates were so high, a lot of refrigerated carriers opted to haul dry freight instead of running their reefer motors. I think you'll see the reverse happen now, where those reefer carriers that have been hauling dry freight will switch back to the more lucrative produce season, tightening dry van capacity. That's sort of that capacity migration that we typically see this year. So, Jack, that could be part of it. Driver shortage could be another part of it. Imbalanced networks are still a huge factor, and so are high rejection rates, according to our shippers. Eric, any thoughts?
Yeah, I agree with all those points. I think the underlying theme is also our routing guides intact. So if there is that routing guide leakage, how much of this is going to spot, and what are the specific processes that various shippers have for spot quotes? What are they benchmarking to? Are they benchmarking at all? How are they gathering and capturing that information? But with more spot, with less stuff on tariff, and if you have a service failure in that environment, and then something goes back out to spot, you're going to continue to have very high prints in the market, and those kind of show up in the indices, and that drives both broker and carrier behavior.
Right.
We have a final question that I missed, and I apologize. Hire Master asks, what is the impact of the increased use of mini bids on the market, and how do you suggest companies utilize them?
Can I take that one, Dean?
It's all you, Eric.
So again, this is something. Sourcing events are difficult. It's a lot of data that you have to pull together in a very short time period, and you oftentimes are going to continue to use the same carrier base that you have. Specifically, if you're a large shipper, it's not always the easiest to bring new carriers into your ecosystem. You've got legal contracts and things like that that do take time. So when you're looking at mini bids, the first thing I would do is I would try to understand what part of my network is stable. And by that, I'd be looking at rejection rates. I'd be looking at what's going to spot. I'd be looking at the variance in what my tariff is versus when it does go to spot, so I can understand my true cost of a rejection, and try to segment my network out that way. And if I can do that, then I can kind of put that out of sight, out of mind for a while, and fingers crossed that that continues to be the case. But then really start to strategically attack on the areas that are not stable. And the way I would prioritize that is what's subject to seasonal factors that is in that instability. And then I would try to look at those first, and not just try to get them back on tariff, but then actually try to get a true backup catch-all rate behind those. So, get that primary rate in, but then not necessarily build this routing guide where you're kind of stacked in and everyone's really close to each other. Look at your distribution of bids that come back in, and look at, so if you've got some bimodal distributions, go ahead and award to, that first mode, but ink something, get something on contract in that second mode that's kind of at that median. So if something does fall through, you at least have a solid backup rate.
Got it.
I think it would be interesting to hear you and Dr. Kaplis talk about that, because Dr. Kaplis is very bullish on, not to put words in his mouth, but on like shortening the duration of RFPs and just trying to make things get marked to market more aggressively.
He's got a great piece coming out. I think the title is the annual bid is dead, long live the annual bid. So it's going to be a great piece to read as soon as that comes out this week. All right. Okay, so I think that's it for the show. If you've got any more questions that didn't make it in here, you can always hit us up at askiq@dat.com. This email hits all of our inboxes and we get to those pretty quickly. Reminder that you could get all of the weekly updates if we didn't answer your questions today at dat.com/market update. Chris Kaplis has got a great Freight Bond podcast due out on April 8. He'll be talking to Doug Wagner, CEO of Echo Logistics. And for those of you interested in some free lane rate data, we're also offering a top 50 lanes report free. Just ask IQ@dat.com and we'll send those over to you each day. And remember to check out the Miller Transfer Freight Focus at 7 a.m. tomorrow. And that's it's all we really have about to talk about this week. So with that, have a good rest of the week. We'll see you next Tuesday at 10 a.m. Eastern. Thanks for watching.
Bye all.